All right, we are back, ladies and gentlemen. Welcome to Finom Group's State of the Market video. As always, I'm your host, Seth Golden. I am joined by the illustrious and nice shirt you got on there, Brad Carter. Look at that. This guy's going to Hawaii on us.
Well, it's been like 109 degrees lately.
Yeah. Yeah, Florida is showing up right now as I think it said like the fourth or fifth hottest month of July in the history of Florida.
Wow.
So yeah, I mean we're regular. I've never been able to say that word, so I can't. Usually we're usually 96 here like every day this month. So, and that's about 5 to 7 degrees over what it usually is. So
Yeah, we're about 10 degrees above.
nah, wow. Jeez. All right. Well, I'm not going to get into the whole climatology thing, and I certainly don't want to, field any, myths about what is it, global warming, or try to, dispel any myths about global warming by introducing facts. But as most of you can see, that is, what we're going to focus on this week: myths versus facts. And there are just so many myths and colloquialisms out there in the investing world that are rooted in nothing but nonsense. It's hard to say rooted in nonsense in the same that in and of itself might be an oxymoron. But anyways, that's going to be kind of the focus here this week: myths versus facts. We're going to dive into some of the the Fed balance sheet issues, and how well or unwell does the S&P 500 correlate with the Fed balance sheet direction, and valuations, myths about valuations as well. All right, so with that, let's get to our first quote, and this week it comes from yours truly. Take it or leave it. Remember that valuation is only expensive relative to history and irrespective of the future. If I might introduce you to the likes of NVIDIA, right? I mean, NVIDIA was said to be expensive before it basically doubled in price. But again, when we talk about, is a stock cheap or is it expensive? What's the right valuation? We generally need history to offer us some kind of guide. So in that respect, I can fully appreciate why today people are saying, well, the market's too expensive, right? Not individual stocks, but they focus on the market and they say at 19 times earnings, with the 10-year yield at, let's call it 3.75%, the market's too expensive, right? But I think it demands a lot more context, and we'll do some defining of that context as we go along here. One of the things that we do quite a lot is we study data as investors. We disseminate a lot of quantitative data, a lot of economic data throughout the course of the week here at Finom Group. But what is the relevance of that data? Well, the reality is you define the relevance. Data can be extremely relevant or have almost no utility whatsoever. And what distinguishes between highly relevant data and basically no value in the data is the sequencing that goes along with the data. I said this a while back in November of 2021. Market participants can access data points. Access is not the struggle. I mean, in the information technology era, in the world of FinTwit or Twitter, there's a lot of data out there at the press of a button. Finding the data is not as hard as it used to be. The real struggle is the sequencing of the data. Without the appropriate sequencing, the data loses its value or utility for an investor or trader, rendering it noise in a sea of, or you just, an ocean full of data points. So it really does come down to, can you sequence the data appropriately within a given regime, market regime or macro market regime? So I want to keep this front of mind as we continue forward with our state of the market, sequencing of the data. One of the things I said more recent, I actually had this discussion with a gentleman on Twitter probably 3 years ago. So coming out of COVID, right? I think it was like April. His name is Tiho Burkan, popular on Twitter. And my claim was that, and I believe still, that the S&P 500 forward PE multiple is likely to average 20 times or better over the next 10-year period, if not even longer. He, in this discussion I had with this person, he thought it was hilarious. There's no way that's going to happen. But the reality is, we are on the doorsteps of a 20-time multiple being the trailing 5-year average PE multiple. So in 2024, the S&P 500 forward 12-month PE will possibly express the prior 5-year average PE of 20 times or greater for the first time in history. Now remember, folks, I've said many times, the PE multiple expands over time. The only thing that kind of trips investors up from recognizing this truism, it's not a myth, it's a truism, is the fact that, during the dot-com boom or bubble, the S&P 500 forward multiple went up to 27 or 28. And we've never seen that since. So we've been 20 years without getting back to that high. But that's what happens in bubbles. It distorts trends. Leading up to that dot-com bubble, the PE multiple had done nothing but expand through the life cycle or existence of the S&P 500. So think about where we ended in 2019. The forward PE multiple for the S&P 500 was 20. When we ended 2020, after the whole pandemic, we reopened, we finished the year with a new all-time high, the PE multiple stretched to 21. At the end of 2021, the PE multiple was 23. So we started 2022 with a PE multiple of 23. We ended 2022 with a PE multiple of about 17 times. If we finish this year with a multiple of 20.5 or better, the trailing 5-year average PE multiple will be 20.5 also. PE multiples expand over time. More important, probably, is the fact that they don't tell you, the PE multiple doesn't tell you what the S&P 500 forward 12-month return is. If you had asked anybody at the end of 2022, given the whole macro climate, right? Ending the year at a 17 times forward multiple, where they thought the market would be in 2023, or the multiple itself, do you think anybody would have said 4,500? I doubt it very much. But that's the point. When you think that you're going to do some kind of savvy investing based on the market's valuation, the market likes to make a fool of a great many people. And I think that's exactly what the market has done this year for those who were questioning the multiple at the end of last year. Here's the other thing to consider so far as sequencing the data. Okay, so now we know what the last 5 years trailing PE multiples have been. Let's think in the context of this market rally year to date and last year's bear market. Did last year's bear market come with a recession? No. So what are we actually doing this year with this new bull market? So here's something I posited in my head. The first leg of an S&P 500 recovery corrects the failed recession pricing and the PE contraction by mean reverting PE to the trailing 5-year average. That's the whole point on studying past PE multiples. We're trying to validate what exactly this market is pricing. Because last year, we thought we were going to have a recession based on how quickly the Fed was hiking rates. But we didn't have a recession. We may not even have an earnings recession on a year-over-year basis, folks. So what exactly is this rally all about? In my opinion, this is the first leg of the rally that basically corrects last year's recession and PE contraction that never came to pass, the recession that never came to pass, at least to date, and getting back on trend with the 5-year average PE. So if that's the first leg of the rally, if that's what we're doing with this first leg of the rally, the second leg of the recovery prices forward 12-month EPS. We may not, folks, we may not have yet started the actual pricing of the next 12-month earnings. So the second leg of the recovery prices the forward 12-month earnings per share. If we can assume the recession pricing included earnings recession that did not materialize. So we still need earnings to come in as, as they're forecasted, which is basically flat to up 1% on a year-over-year basis. That would be the second leg of this rally. Point being, for those who think this is the top, we've gone too far, look at valuations. What valuations? Are you prisoner to the moment, or are you actually looking at the trailing 5-year valuations? Because if you are, then we still have room to go. And the valuation is not rich. It's on par with the prior 5 years. Okay, I think we're all on the same page here. One of the studies that we looked at, right? How do you know you're in a new bull market? Well, you've had a 50% retracement of the decline, right? We've heard that before. So in the context of we haven't had a serious correction since the March lows, we haven't had, considerable pullback. The biggest pullback since the March low for the S&P 500 has been 2%. The biggest pullback for the NASDAQ has been 3%. Are we due for a bigger pullback? Remember, the market doesn't have an expiration date. It doesn't clock in or clock out like you and I going to work. It lives in its own world. But here's an interesting study so far as after you've had a 50% Fibonacci retracement of the bear market low, these are the drawdowns for all those occurrences. Once we had the 50% Fibonacci retracement in 1948, after that, sometime after that, there was a 13% consolidation. Well, look at 1949. 1% drawdown. That was the greatest pullback after the 50% Fibonacci retracement. No pullback whatsoever in 1958. The 1962, no pullback whatsoever after you did the 50% Fibonacci. No pullback. 1970. 1975, corrected 10%. 82, 2%. Most of these are single digits, folks. The average pullback after the Fibonacci retracement is only 6%. But look at the upside after the 50% Fibonacci retracement. And for those of you who are not familiar where that level came into play or signaled, that was 41.95 or 41.96. The upside, the average upside is 20% beyond that point. So we've gone, for round number's sake, 4,200 to 4,500 as of today. That's not even 10%. but the average move is 20%. Most of these are even higher than the average. All good? So here's the other point. We're sequencing the data. So what's next on our list, right? And we're talking about valuation as well. There's a lot of folks out there right now who swear this has gone too far. You know, the valuations are too rich. It's time to take the chips off the table. It might even be time to short based on valuations. Well, historically, if you had used that excuse, this chart here from Goldman Sachs, going back to 1990, they use a composite model of various valuation metrics to define what decile valuation the market is in. And here are times, 1992, the market crossed the 9th decile of 10 deciles. So it's in its second to highest top valuation level. But from that point on, the market rallied 342%. When it entered the 10th decile in 1995, it rallied 194% from there. Here in 2013, when the market eclipsed its former high from 2007, the market was in its 9th decile valuation, second highest valuation decile. We all know that the market continued to rally up to 2020, another 211%. Do you really want to be using it, valuation, as an excuse and as to why you should not be looking to buy any dip that materializes and getting out of this market now because you think it's too richly valued? Anything can happen tomorrow. A recession, for whatever reason, can happen, within the next months, 2 months. We can get an exogenous shock. These are things, if you're anchored to that as an investor, if you are constantly worried about a black swan event, there are 9 to 5 jobs out there that, you don't have to worry about such things. Recently, Bloomberg had covered Wall Street sharply split on the path for the S&P 500. Like, you have Mike Wilson of Morgan Stanley saying 3,200 for the S&P. You've got Michael Cantro, right? I call them Mike and Mike. He's out there with 3,200 for the S&P 500 by the end of this year. But then you've got Ed Yardeni at 4,600. You've got Fundstrat's Tom Lee at 48.25, recently raised his price target to 48.25. So the disparity between the trough and the peak price targets has only been wider way back there in 2003. But here's the interesting thing. When they've been this wide, it's usually been a cyclical bottom in the market. Here's another time in 2009, cyclical bottom. This was kind of the muddling phase, but that was the peak of a muddling phase in 2012, where we did have the 2011 correction, and that was another cyclical bottom. Here in 2019, that was a cyclical bottom as well, and we rallied 31% in the S&P 500. Big disparity here in 2022. We did actually fall over, but 2023 is the second largest disparity, and it looks like once again we've got a cyclical bottom off of the 2022 lows. One of the things that I recognized as well, this is also from Bloomberg, their S&P 500 target points to most bearish second half. So this is just looking at the strategist's second half price targets. And what I realized was each time that the strategist, the consensus, believed that the market was going to be lower than the first half of the year, finished lower than the first half of the year, was 2020. Here's 19, 20, and 21. So in 2019, second half of the year, the market was up 9.8%. In 2020, second half of the year, market rallied 21%. 2021, it rallied 10.9%. Here in 1999, when they thought the market would go lower in the second half of the year, the market rallied 7%. Every single time, strategists thought that the market would be lower in the second half of the year than where it began that second half. The market was positive every single time. It's why they're paid the big bucks, right, Brad? As I often say, they're credentialed. I don't think they're qualified, though. All right,
You know, go ahead.
No, I wanted to get into the Fed balance sheet and the S&P 500. You know, how many times did we hear Josh Brown go on CNBC and say, and Liz Ann Saunders and Cameron Dawson of New Edge Wealth and Liz Ann Young of SoFi, Liz Ann Saunders of Charles Schwab? Well, the Fed's going to be reducing its balance sheet. The S&P 500 is not going to perform well with less liquidity. Michael Santelli. Now, we've said many times, there's no correlation between the S&P 500's direction and the balance sheet direction.
Why would there be?
Yeah, exactly. There's no plumbing that connects the S&P 500 to the Fed's balance sheet.
Right. What does that have to do with how much Seth Golden puts into the market today?
That also. Like, how does the Fed's balance sheet change Apple's earnings? You know, I mean, these things are just ridiculous what people believe. But Mike Santelli on CNBC, basically validated everything that we've said for many years now here at Finom Group. There's relationship issues between the Fed's balance sheet and the S&P 500. But now, even though we can evidence this, folks like Tom McClellan, while true at one time scale, that misses some big context. He basically said, if you look at it over, an election cycle, so a 4-year presidential cycle, he says that's the only reason why the S&P 500 has deviated from the so-called correlation with the Fed's balance sheet. Now, mind you, he knew what year it was at the beginning of the year when Tom McClellan went on CNBC saying, M2 supply is negative and the Fed's reducing their balance sheet. This is going to be a down year. He knew that it was the pre-election year. And during a pre-election year, the S&P 500 has been up every year but one. And that was in 1931. So why, when Tom McClellan went on CNBC at the beginning of the year, knowing this, he said the market would be down. Now he's excusing the relationship that doesn't exist between the S&P 500 and the Fed's balance sheet by saying, it's only because of the presidential cycle pattern. Right? It's funny how narratives shift and the bears look for excuses, to assuage what has been a myth. I mean, we've shown it this was 2014, the Fed's balance sheet peaked, and it trended downward from 2015 all the way to 2020. What did the S&P 500 do from 2015 up to 2020? As the Fed's balance sheet was going lower, the S&P 500 was going higher. Now we ask the question, well, here the Fed's balance sheet is going down and the S&P 500 is going down with it. Coincidence, folks. It's coincidence. That's all. You can't say just because it was going down with it, that means throughout the whole history, the Fed's balance sheet causes the directional movement of the S&P 500. Here's the thing also you have to recognize. We're taking two different entities. We're taking the S&P 500 from an arbitrary value, and we're taking the Fed's balance sheet at its own arbitrary value. Let me ask you a question, Brad. I've got a horse and a camel. Okay, and I'm going to put them behind the starting gates. I'm going to open the starting gate. Which horse is the fastest?
Out of the
It's
gate?
the horse, right?
Yeah.
It's the horse. I've only got one horse. I've got a horse and a camel. It's the horse. It doesn't matter how fast the camel goes. The question is which is the fastest horse? I'm using completely different animals. I'm putting them on the same path. But at the end of the day, I want to know which is the fastest horse. That's what people are doing. They're taking two completely different entities, the S&P 500, at some value, and the Fed's balance sheet at some value. And they're trying to say, well, at some point in time, as long as I can have the starting date be the same time, then I can define correlation. It doesn't work that way. It's like me also asking the question, well, the camel actually won the race, but the horse stopped to have a drink of water. Did the camel winning the race force the horse to take water? Did it cause the horse to drink water? No, of course not. In the same vein that the Fed's balance sheet doesn't cause the S&P 500 to go up or down. What you don't see people do, and this is the only way you can validate correlation, right? Because here we're talking about the S&P 500 at 600 at the 2009 bottoms. That's the value we're using. And we're using the Fed's balance sheet starting at 1 trillion. They're just two different values, but we're trying to measure the same path. We can eliminate the values by indexing both of these different data sets to 100. If you index them to 100, then you can find correlation. So when we did that in this video here, I put the link. When we do that in the video, it shows there's no correlation. At best, you can get a monthly correlation of less than 0.3%. A qualifying correlation, meaning X causes Y to do this, has to occur at 0.8 or better. The best we can get was 0.3 when we index both values to 100. There's no correlation, meaning the Fed's balance sheet has no causation on what the S&P 500 does. So that's a myth that we busted long ago, but it is nice to see the folks at CNBC get it right sometimes. Here's another chart. This is kind of a more simplistic way of looking at the difference between coincidence and correlation. Ice cream sales and shark attacks. Both ice cream sales and shark attacks increase when the weather is hot and sunny, but they are not caused by each other. They are caused by good weather with lots of people going to the beach and both eating ice cream and having a swim in the sea. Both ice cream sales and shark attacks increase when the weather is hot and sunny, but they are not caused by each other. Sharks don't attack because people eat ice cream. I mean, it's the difference between causation and correlation. Too many people think that they can put a couple lines on the chart and they show a similar pattern, and that means one causes the other or one is correlated with the other. And it's the same thing, folks, with the relationship between rates and stock returns. People have said, well, if the 10-year goes higher, stocks are going to go lower. Folks, the S&P 500, the NASDAQ, they're at 1-year highs. Just last week, the 10-year was 4+%. It was near 1-year highs. The 2-year was at 1-year highs as well. But I thought you said that, stocks can't go up when yields are up. It's never been true. It can cause more volatility. Yields moving higher can certainly cause more volatility. But at the end of the day, stocks price earnings. Don't price.
Yeah, that reminds me that I've come to the conclusion that even the yield curve inversion is likely a spurious correlation.
Oh, I say the same thing. How many times? See, the thing is, we don't have the counterfactual for the last 3 or 4 times that the yield curve inverted. Why? Because after the yield curve inverted, I think it was in 2000, in 2001, we had 2 morons fly into the World Trade Center, and then a week later, it was declared a recession. So we don't know that the 2000 inversion was correlated to the 2001 recession. 2008, we had deregulation like you wouldn't believe, such that the mortgage market and housing industry, you didn't have to have a job, you didn't have to validate any kind of income. So things got crazy. It was just stupid deregulation. And so then we had an exogenous event, a deleveraging exogenous event. So we don't know that the yield curve inversion in 2006 was correlated to 2008's great financial crisis. And then, of course, the 2019 yield curve inversion. Well, what happened in 2020? Are you telling me that the yield curve inverting created and was correlated to a global pandemic? So I agree with you. The last 3 or 4, it took exogenous events basically happened in a short, span of time thereafter the yield curve inverted. So we don't have a counterfactual for at least 4 of the last recessions. I agree. I wholly agree with you. And by the way, we've anniversaried the yield curve inverting from 2022. We're a year past that. But to your point, we do have data. We have actual data that validates there is basically no correlation between any of these yield curves. Look at this: 10-year minus the 1-year, 5-year minus the 2-year, 10-year minus the 3-month, 10-year minus the 2-year. Look at that, 10-year minus, it has a correlation of 0.17. What do we need to get to? 0.8 at least. Almost, there's not a single yield curve combination or spread with greater than a 0.50 that can be correlated with 4-quarter forward GDP. Not a single one. Myth debunked. Good timing on that yield curve, brother.
Had no idea that was coming up.
Yeah, we don't pre-plan this, folks. All right, but here's another one that, and this may have been true in the past, but this is a very unique cycle, folks. Last year, this was all the craze. In the past 7 recessions dating back to 1970, equities never bottomed before the Fed began cutting rates. First of all, is that enough of a sample size? For those of you who study statistics, you know you need at least 6. So it qualifies. But I don't think this is enough for me to feel comfortable to allocate or not allocate capital. The past 7 recessions, equities never bottomed before the Fed began cutting rates. Peru Sashina, which has hundreds of thousands of followers, over the past 50 years, a recessionary bear market has never bottomed before the first rate cut. In all instances, except 1980, The S&P 500 kept declining even after the initial rate cut. In 1980, recall, we had a recession, but the market continued to go higher. It was one of those years, and there's 4 that we can name, 45, 49, 70, and 1980, where the market continued to go higher through a recession. But here's the problem also. This is wrong. In the past 7 recessions, dating back to 1970, equities never bottomed before the first rate cut. Not true. 1974, the Fed cut in November, but the market had already bottomed in October. So this is another one of those, you can't really tell. The lines on the chart aren't very, they're such a broad time frame in between the recession years, you can't really tell. You have to take it on faith. So this was 1974. The market actually bottomed in October. The Fed didn't cut until November. So this is wrong. Let's look what else. 82, the Fed cut in July. The market did bottom the next month. Fed cut in November of 1987. The market bottomed in November of 1987. The Fed cut in 1990, October. The market bottomed in October. The Fed cut in January of 2001, but the market didn't bottom until 2002, July 2002. It didn't take off and form a new bull market until March of 2003. Fed cut in January of 08, the market didn't bottom until March of 09, more than a year and a quarter later. The Fed cut in March of 2020, and we know the bottom was in March of 2020, the same. Here's the point. The market has bottomed before the Fed cut. The market has bottomed the same month as the Fed cut, and the market has bottomed well after the Fed cut. The Fed cutting is not the deciding factor, obviously, because the market has all different kinds of responses before and after. And that's the point. This is just BS data. There's nothing you can do with this based on the actual historic results. It's just stuff for Twitter. It really is just stuff for Twitter, folks. Here's another one, right? That one has been debunked. That's another one that's been debunked. And this comes from Bank of America, by the way, and Barclays research. Bank of America has one literally for every single year, though. Okay, that didn't work. Let's try this one. Bank of America, since 1980, peaks in the U.S. 2-year Treasury yield have always been followed by a risk-off event within the next year or so. The full extent of damage is unknown until the peak in policy tightening is behind us. We are clearly not at that point yet. So this is just another one for the current calendar year. The 2-year actually peaked a couple of months back. We tried retesting that level here just last week. But this is what they do to themselves. All right, my compadre there must have taken a drink break, so I'll carry on, folks. Don't worry. I can do this myself. I don't need parental supervision, as they say. But here's the actual data that Bank of America Global Research is pointing out. We can go all the way back to 1961, and the data is not lying. This is the S&P 500 down at least 19%. So if the S&P 500 has been down at least 19% from the all-time high, and then these are the dates of the 2-year Treasury yield, the peak date, the percentage change thereafter is really bad, folks. I mean, you've got double-digit declines and big double-digit declines thereafter. So this is the new one for calendar year 2022 that, kind of usurps what didn't really work out last year. It's a very unique cycle, folks. Be flexible and open-minded. One of the things that we've recognized during this inflation cycle is that should we have really been surprised that the ISM manufacturing peaked in June of 2022? when inflation peaked. And ever since then, manufacturing has been in a recession. ISM below 50, right? Because we've been in disinflation since that period. The NOPE index, as it's called by the Lightholt Group. So what they discovered is that if you take the pricing component out of the new orders within the ISM manufacturing index, you get a truer gauge of manufacturing activity in the United States. And for most of this disinflationary period, where the ISM headline has moved into recessionary territory, the NOPE index has been positive, which tells me that manufacturing activity as a whole is still in expansion territory. Volume transactions are still positive. But remember, it's a survey. Brad, if I told you that I want to rent one of your houses, but we're in a disinflationary regime, you listed the house for rent at $1,800 a month, but it's a disinflationary regime. I can only pay you $1,500. Are you going to be happier or more disgruntled with your rental transaction? And that's the same thing that's going on with manufacturing. This is the actual questions that they are asking to producers, wholesalers, and manufacturing agents. Well, if prices are going down, I'm going to be disgruntled about my pricing, even though my transactional volume is still positive on a year-over-year basis. And that's the beauty of the NOPE index. You take out the pricing issue, you get a truer understanding of the volumetric transactions in manufacturing. Market breadth is so bad, huh? I think starting points as we segue here to the actual markets and talking about market breadth, again, sequencing data, starting points matter. You know, if we start from the October lows, S&P 500 industrials equal weight has far outpaced the S&P 500 by almost 5 percentage points. Even on a cap-weighted basis, industrials have outperformed the S&P 500 and the S&P 500 equal weight. Starting points matter, folks. The bear market ended at the October lows, not at the start of a new calendar year. How good or bad is breadth for all of the naysayers? Now, you haven't heard much grumbling about breadth lately because it's transparent now that breadth has broadened out. But even prior to this more broadening out of breadth, if we look at the NYSE daily advanced decline line in the first year of a major S&P 500 advance, look at where we are. With respect to the average performance of the NYSE advanced decline line of a major S&P 500 advance, that first year, we are skirting the average consistently here. We have been no better and no worse than past first-year advances in the S&P 500. A lot of stuff people say, right? That has no merit. All right, let's look at the date of this chart. This is from July 7th. That's the date of this chart where I recognize I'm looking at value versus growth. The value ETF versus the growth ETF. What we recognize is that value has been greatly underperforming growth. But it's come down to this point that may prove support. Here's the other thing to note, that even while value was greatly underperforming, especially this month here from June into July, basing, look at the RSI. It troughed at the beginning of June and has been moving higher ever since. So we have actually a bullish divergence in the value versus growth, suggesting that there might be some outperformance in value versus growth, at least in the near term. Now that chart was July 7th. Let's see if we can bring that up really quickly here. I know we're getting long in the tooth. We may not be able to cover everything in this week's State of the Market, but you can obviously look at the published materials at your leisure. So here we go. We're going to update. And well, this is today, but we did bounce. This is why I say in the near term, we did have that bounce. We did base, but with today's price action, we are making a lower low in the value versus growth performance here. Now, here's the other thing. What did Finom Group do to take advantage of what we perceive to be a basing in this performance ratio here? We went long small caps. Back in June, we started building a position in the IWM. Our Finom Group Mastermind Options and Premium members, we started building this position at $175 a share. A great constituency of small caps are value stocks, their energy, their materials, their banks, financials. So from 175, we got out of it at $190.90 this week. Again, sequencing the data. All right, let's move forward here. And there it is, folks. Now we're long from 175 cents. Oh, it should have said 190.90. I don't know why that came up as 177.70. It's supposed to say 190.90. Nobody called me out on that in the trading room. All right, let's kind of make this a last but not least situation here. Over the last 50 years. So for our Finom Group members, contributors included, you got this data from Wayne Whaley, I think last Saturday or Sunday while I was on vacation. And it basically is about the current trading week that we're in. If the previous quarter, meaning April 8th through July 8th, was positive, up at least 5%, April 8th through July 8th, up at least 5% the last 50 years. These are all the occurrences. The following week's performance was positive 21 times and down only 2 times. The average gain that week was 1.9%. The median gain, 1.93%. Folks, this was a great trading tool or set of data to possibly capitalize on the current week. Now, Tom Lee, at the start of this week, to Fundstrat members, said that he believed the S&P 500 was going to gain 100 points this week. Went on CNBC saying the same thing to the broader public. As I've said before, I shared this data, with Tom Lee and the crew at Fundstrat. Tom was of the opinion that it would be predicated fundamentally on a better than expected CPI, which we got, right? CPI came in better than expected to the downside. PPI came in today better expected to the downside as well. Folks, I mean, talk about a very short-term call and get 100 points. People thought he was crazy at the beginning of this trading week. But fundamentally, it's working out, and quantitatively, it's working out as well. So I'm going to wrap that our text here with all this data, and there's a lot more that I encourage you to read through here when you have some time. But with that, I'll wrap it up. I'll wrap up our prepared notes and kind of want to get your thoughts, Brad, on where we are in the market, and what you've been doing and how you maybe see things playing out now that we're already at 4,500 here in the month of July.
You gotta you've got to bet that we're going to finish real well this year. Better than I would have thought in January. I was bullish in January, but I was thinking, okay, we might get back to 46 or so. You know, it'll be at least a pretty good year.
And I think it was Adam in our trading room has had a price target of 4,600 since the beginning of this year.
It's low now. I think I'm not going to predict 49, but it wouldn't blow me away. You know, both these uptrends and downtrends tend to take on a life of their own.
Yeah.
And we've got to remember just how much we sold off last year in a historical context. And that's what all the bears were missing. You kept saying day after day after day after day, what was last year about?
Right. Right. What do you think last year was about?
So no, I think 48 or so.
Sounds good to me. Now, what do you think about earnings? Because right now, earnings are expected to be flat year over year. Based on what we've seen in the first quarter, what we've already seen coming into the second quarter with the companies that have already reported early, what are your thoughts on earnings? The estimates are flat to up 1% year over year.
Well, first I would say if they're flat to up 1%, we'll be fine. Because the direction has more to do with it than how much I think as far as the direction of the overall market.
Do you think that the earnings estimates are fair right now, or do you think that the corporates are going to?
Considering the quarters we're getting into now, they're probably a little low.
Okay. I would tend to agree. Yeah, I think that I've said pretty much all along, I think we get to $229 per share in earnings, as opposed to the present day estimate for the full year of $219 a share. So I think we have $10 of upside that is not being captured by the consensus analysts. I could be wrong in that, but based on the beat percentage that we saw last quarter, which was like 4.5% beat, and they're expecting a 7.2% year-over-year earnings decline in the second quarter. So say we beat that by another 4%. I'm not going to be too far off. So
no, and we've said all along, it's those third and fourth quarters that really we should start seeing things turning around and looking real good. So
yeah, and the second leg of the rally is going to be eventually about pricing the next 12-month earnings. And if we're already, if consensus is already light, i.e. wrong, the life of its own characteristic that the market takes is going to be those forward-looking earnings. And people will not perceive that. People will not abstract, that and say, this is why the S&P is 4,700. There's no way it should be here. And remember, we don't get earnings until after the fact, right? I mean, we're in the third quarter. We're only getting second quarter earnings now. So
one more piece of trivia I was thinking about a couple of days ago. If my recollection is correct, we've only seen the UVXY double split in 1 year, one time.
One time, yep. That was 2017.
I think it could happen again.
That would be funny. That would be awesome.
Because when they double split at this time, I went, man, you didn't go enough. That's not
yeah. I heard you say that. Yep. All right, folks, we don't want to take any more of your time. Be on the lookout for this weekend's macro market research report and tune in next week to the state of the market. All right. Have a great week, everybody.